All right, welcome everybody to another session of our FinTech Forum session series. So today is of course Wednesday. It's Hum Day. So congratulations for getting over the week. I hope everybody has their cup ready. Of course, not sponsored by Nescafe or Nestle in any way. It's just a hope. Yeah. So in case there's anyone out there from Nestle who would like to sponsor, that would be great. But anyways, today we have a really exciting session, I would say, because not only are the names that we have here today, I would say household names, but also the products that they have sort of involved in have really changed the way that we have thought about investing. So that is something that is not easily done. And today, the whole idea at the end of this session is to really understand what were the steps that they took in order to undertake this very, very, I would say, difficult and momentous task that they have done. And so if you can go on to the slide next to this, you can go to the next slide. So on this slide, we have the FinTech Map. So we have all of the available FinTech here right now in Malaysia. And there are definitely some household names over here, and some which are less familiar. But we first here today, we have some of the most recognizable names. So if you go on to the next slide, in the area of wealth tech, which is the robo-advisory space. And so over here just shows a short chronology of how the industry has sort of evolved over the past decade. And to understand what was the work that went into this, we have with us today three very, very esteemed speakers. We have with us today Puan Dura Baharudin, who is the MD of Value Partners right here in Malaysia. We have Mr. Freddie Lim from Statutory. And of course, we have Mr. Izzah Fadli, who is the country director for Wahid Invest. So we will be hearing from these three very esteemed individuals about the work that they have done over the past decade and the work that they will have to do in the foreseeable future and to really revolutionize this space and how we all invest. So with that, if you can go into the next slide, I would like to invite Puan Dura to talk a little bit about how she views this space. Thank you.
Thank you so much, Farid. Good evening and welcome to all to this session on the second installment of the FinTech Forum series, Active and Passive Investment Competing or Complementing. So just a quick introduction. I am Duraini Baharudin. I lead the team at Value Partners here in Malaysia. And we pretty much are probably one of the few asset managers not backed by a bank and the first foreign asset manager that has come to Malaysia to also launch ETF, which is why probably some of our experiences and views as an issuer is probably going to be a bit relevant to the conversation that we're going to have today. But before we go there, then I thought we do have a bit of slides that we're going to be sharing. And I thought that it's very important to demonstrate or to share with the audience today the kind of work or who Value Partners is, because then that will bring into context exactly how a very old firm like Value Partners can be a part of this very exciting ecosystem, which involves all the wealth tech players, the robo-advisors and so forth. So Farid, you can move to the next slide. So Value Partners, for some, maybe you are not familiar with Value Partners, but we've actually been around for about 29 years, right? And we are actually a Hong Kong-based asset management firm, and we're listed on the Hong Kong Stock Exchange. We are actually the only local asset management firm in Hong Kong that's listed on the stock exchange, and we were listed in 2007. We actually have international presence. We started in Hong Kong. We have a big presence in China via our Shanghai and Shenzhen office. We have a rep office in Beijing. We also have a presence here in Malaysia, Singapore, and also London. So as much as we are a very Asia-based, Asia-focused asset manager, we have presence pretty much all over the world, and we service clients all over the world, predominantly for Asian and China strategies. For those who have dialed in from Malaysia, our founder is Datuk Sri Chia Cheng Hai, who's also a fellow Malaysian, who migrated to Hong Kong about 30 years ago as a journalist and changed and took on a second career from journalism to investment, and naturally set up his firm and brought it to where we are today. And why this is very important, because Datuk Sri Chia Cheng Hai is known as the Warren Buffett of Malaysia. And as some of you may know, Warren Buffett is a strong proponent of value investing as part of an active approach to fund management. And that's also the DNA of Value Partners. Okay, so I put that in context. And then if you move on to the next slide, we have a long history of our development here, from being 5.6 million US dollar asset under management, which was pretty much only in China equities at that point, to where we are now at 13.2 billion with about 200 headcounts strong. 80 of them, or 80 to 90 of them, are actually investment manager, focusing largely on active investments. So with that, we have also evolved over the years from starting as an equity house. If you move on to the next slide, is the kind of offerings that we have now. So this is why I say it's very important. From just starting on the left of doing equities from the year 1993, pretty much anticipating the signing up to the World Trade Organization by China, we actually evolved into fixed income. We actually we are currently the largest China bond manager in the world, and we also moved on to alternatives. And also, what you see at the very end is quantitative investment solutions, which is passive investments, or ETFs. So even a firm like ourselves that has been around for 28 years, we continue to evolve in order to always provide the right solutions or better solutions, investment solutions to our investors that fits with the changing of time. So this is where Value Partners, even though we're a very old player in the market, we also are trying to evolve so that we adapt and to the changes in the ecosystem. So if you move on to the next slide, just very quickly, this is pretty much what I wanted to share about the ecosystem here in Malaysia. So you would see that there are all these ETF products. The ETF or passive space in Malaysia is not as, it's getting more vibrant, but it has a long way to go compared to our more developed peers, for instance, the US, Japan, and so forth. In Malaysia, we try to, if you look at it from a broad perspective, we bucket the ETF or the passive strategies between Malaysia, regional, and single country. And if you see, the concentration is still largely in Malaysia, even though these ETFs are issued in Malaysia, which is why I would say that a player like us, Value Partners, when we come to Malaysia and we see this landscape, we want to find a way to bring our expertise to fill up the gaps, so that when investors choose to evolve in their investment choices, we are there to provide that particular service. So this is very important, to me, it's a very important slide, especially if you're trying to understand the ecosystem, because this actually is a snapshot of what you have now and whether or not this is sufficient to cater for the needs of investors of the future, especially the young investors who are piling up their capital and participating in capital markets. Moving on to the next slide, Farid. So, and in bridging this gap, right, because I was talking largely on the limited products that we see in the market, in bridging the gaps, what's very important in understanding how to get there is actually understanding the correlation between all these different markets. And what we also tend to identify is that whilst a lot of investors in Malaysia predominantly, they're very focused on something that they're familiar with, which is Malaysia equity, Malaysia equity funds, Malaysia fixed income funds, and so forth. And then because of that, their option to diversify their portfolio becomes a bit more limited. And that is not just a problem on the investor side in what they choose, it's also on the issuer side. What is it that we're offering to the market? So with the players like our friends here in the talk today, Statutory and Wahid, very innovative in their approach in being a part of capital markets, to me it's very important that we also identify the right products that is relevant to the investors, the current investors, in order for them to have a more holistic portfolio of their own, especially in the age where everyone is very proactively and independently making stock selections or fund selections because the infrastructure is ready for it. So when we do this study, it's very important to understand the correlation between what are the most common themes in the market compared to other opportunities that you see. And the higher the correlation and the higher the concentration in strategies that are highly correlated to each other, the more of a gap that we could actually see, and we as an issuer should be filling up. And that's where Value Partners in Malaysia hopes to strongly and actively participate. So moving on to the next slide. Okay, so in our mind, I suppose we're not a robo-advisor, so Freddie and Izzat will have more to say about this. In our mind, in the future, this is how investors, young, old, experienced, new, would be looking at their own portfolio. They'll be looking at allocating it between different markets. Naturally, if they're familiar with mutual funds, they will have mutual funds allocation, or if they're more familiar with banking products, maybe they will take that as part of their portfolio allocation. But we foresee that in the future, this is how investors, an individual investor would be looking at the asset allocation process or portfolio diversification. And in doing so, it's very important to understand the market within which you are operating and what are the gaps that you're trying to fill up. And I would say this is going to be probably part of the fundamental discussion that comes from my side today, is that capital markets is a very jurisdictional business. So you have to look at it from the eyes of an individual investor from that particular market, as opposed to blanketing them or standardizing them across all different jurisdictions, because all ecosystem and history of the development of the capital market is different. So I do hope to tackle that a bit more later. So that's pretty much from me for now. Thank you, Farid.
Thank you very much, Puan Dura. So we heard from Value Partners who, if you were to think about it, creates the raw materials, and then it is then packaged into investment products, which are then passed on to the final investor. And for that, to represent the first of our of the robo-advisory space, we have Mr. Freddie Lim, who's not just the CIO, he is also the co-founder of Statutory. So over on to you, Freddie. Thanks.
Thanks very much, Farid, and thanks very much, Puan Dura. It's going to get exciting later, I promise you. And thanks very much for this opportunity to come to speak with you. I have two short slides. I don't know if we are actually presenting it now. The lots been covered, but the main message I want to bring is that the behavior aspects of investing is also very critical. Sorry, can I get the slides up there and running? Thank you. Yeah, next slide, please. Yeah, so just to sort of emphasize the behavior aspects of investing, we've been in business for the last 4.5 years. By now, Statutory was started in Singapore, and then we came to Malaysia in 2019. And as of now, we also have offices in Thailand, Dubai, and Hong Kong. So having seen so many user statistics and behavior data, we actually did an exercise sometime this year. And in the summary is that in a market drawdown situation, it's very likely, and about 41% of users we've seen, they are very prone to reacting, very prone to actually withdrawing the money at the lows. And this particular slice here is interesting because it takes the trade war in 2018, it takes the COVID-19 market drawdown last year in March as well into account. And it sort of tells you that the impulsive investors do get hurt a lot versus the well-planned investors. What do I mean by well-planned? The well-planned investors are those who, before they invest, they took the pain to sit down and think about cash flows, risk level, how many years they want to invest, why they invest, what are they investing for, and then they come up with a concrete schedule of how they contribute to their portfolios over time. Rather than being a trader-like mentality, these investors have a very disciplined approach in sticking with their long-term investment plans. And these guys, in terms of the bottom part of the table, they average a money-weighted return of 12.85% over the last 4 years that we've been around. And in Singapore terms, and 10.74% in Malaysian ringgit terms. Now, the impulsive investor who reacts to every drawdown tends to not make any return, minus 1.9 in Singapore and minus 5.61% in Malaysia. So that really tells you a lot that the behavior component actually can decide success or failure. Can I have the next slide, please? And just to summarize it further, because we, from very, very early beginning part of our Statutory's business, we sort of felt that the behavior component is going to be a very huge thing. And I think the best way to address it is through helping clients with financial education. So Statutory Academy was created very shortly after the launch of our products. And it's been running for 4 years now, this program. And we found, interestingly, people who attended the Statutory Academy, they're 18% less likely to stop depositing during market drawdowns. They're also 18% less likely to withdraw money during a drawdown. I'm not exactly happy with this result yet because, as I said before, 41% of people are likely to do so in a drawdown. I want to get this number up really high so that we can correct the problem. So early days, we got to keep doing it, but it does have its positive effect. And 40% of these people who attended the financial education academies, they tend to be more regular investors, the disciplined investors who has a very well thought out, very comprehensive long-term plans. And 27% of attendees are now less likely to be impulsive. And during the drawdown, instead of capitulating and running away, they tend to have a cooler head. So these numbers, I hope over time, with more focus on financial education and promoting financial philosophies, hopefully these numbers, we can get it up and to the double from what we see on the screen today. That's my personal wish list. And now I'll stop it here because I can go on for 3 days. But I do look forward to our panel session in a few minutes. Thank you very much.
Thank you so much, Freddie. I really love the slide, that shows the difference between somebody who regularly invests versus the impulsive investor, because it just shows, the importance of how time in the market always beats timing the market, as they always say, right? Anyway, next up, we have a friend which I consider a dear friend of mine, Mr. Izzat Fadli. So just a bit of a fun fact, we used to sit next to each other back in PNB, and then now he's here as the country director of Wahid, and I am now here. So over on to you, Izzat.
Hi everyone, thank you very much for it, and thank you to CFA Society Malaysia for inviting Wahid to this panel session, and as well to Freddie and Dura earlier for their presentations. Next slide, please. So for us, Wahid, we are the third digital investment management company in Malaysia. We launched in October 2019, but before that, we have been available in the US and the UK in 2017 and 2018. Our focus is for everyone, not just the Muslims, but non-Muslims as well, to have access to a diversified Sharia and ethical compliant investment portfolio. And through our platform, the Wahid app, this is the first automated Sharia compliant wealth advisor in the world, and from this technology that we have here, we aim to provide a low-cost solution, a diversified solution to Islamic investors across the globe, and this is to enable everyone to invest in line with their faith. Next slide, please. We are a globally trusted institution. We are licensed firstly in the US with the SEC in 2016-2017, and then in the UK with the FCA. And the next, after that, we were granted a license by the Securities Commission Malaysia, and then after that, we were also licensed in several other jurisdictions as well. So we wanted to have this global Sharia brand to enable over 1 billion Muslims across the world the ability to invest according to their faith. Of course, the anecdotal story here is that our founder, Junaid Wahidna, the idea that came for him to found this company is because when he was traveling in New York in one of the famous yellow taxis, there was a Muslim driver who mentioned to him, because from their conversation, the taxi driver found out that Junaid was a banker, that he invests most of his wealth in one single stock, which is Apple stock, and the advice came from his imam of his place. So Junaid found out that there is this gap where the Islamic solution has to meet with the realities of the financial world. You cannot have your asset in a single asset in a single security because of the concentration risk there. So he found the company, and from there we have expanded to become a global brand. Next slide, please. For my presentation, I would focus more on the halal investing, especially from a robo-advisor's perspective. So as a Muslim, we would very much prefer to invest in line with our faith, and with that we have to find halal investments, which is the permissible investment for us to participate according to Sharia. So at Wahid, we have a full-time Sharia board. They review all of our business practices, all of our products, investments, portfolios to ensure strict compliance. And 5 key points that I would like to highlight here to identify halal investment options is that first and foremost, we are an AUFI conforming Sharia company with AUFI conforming Sharia board. As we know, the accounting and auditing organization for Islamic financial institutions, AUFI is the leading standards issuing body for halal financial services sector. So by adhering to the best practices, we aim to have a consistent review to reduce chances of generating returns from impermissible sources, and hopefully this can translate and give our clients the assurances that their investments are 100% Sharia compliant. The second point here is from the business and financial screening. Of course, we know that to adhere to Sharia compliance, we do 2 screenings. The first one is business screening, which is reviewing the company's business practices, also the products and the revenue sources. We have to prohibit certain returns from producing like certain items like alcohol, weaponry, or returns from gambling. And of course, the main one is riba or interest. And the second screening is the financial screening. We have to adhere to certain financial ratios. For example, conventional debt has to be certain thresholds. Usually it's below 30%, cash portion also below 30%, and sources of income such as the total interest income also has to be below, usually it's below 5%. And thirdly, in terms of operational level, it also has to have adherence to Sharia compliance. So the companies operating and managing the investment fund have to comply with Sharia regulations. So this includes the company not being able to taking on like interest-bearing debt for operational level expenses, and we also have to follow certain business practices. Fourthly is the investment policy. Of course, investment policy have to you have to have an Islamic investment policy. We have a Sharia board that vet the investment products and also conduct ongoing diligence as well. And lastly, the purification reports. while this purification reports is not a must, but a more transparent Sharia board will provide it, because at the end of the day, again, we want to ensure that the clients are comfortable knowing that even the slightest impermissible sources of income are purified. And this is what we provide to our clients starting from this year. Next slide, please. And we take a look a bit at the state of Islamic finance. This is just to give a broad example of where we are in the Islamic economy. So in 2019 estimates, it is represented around 2.9 trillion Islamic assets. We have about 1,500 Islamic financial institutions globally, about 540 billion value of sukuk and 140 billion Islamic funds. And although 2020, it seems that there is zero growth, according to the chart that is shown. This is taken from the 2020-21 State of Global Islamic Economy report. But the CAGR growth is about 5%. So we are expected to reach about $3.7 trillion in terms of the total Islamic assets by 2024. So there's a lot of opportunities here, both from the perspective of the robo-advisors as well as the perspective of the ETF or fund issuers as well. Next slide, please. And lastly, I'd like to touch a bit on halal investing and SRI, because there's always this comparison between these two, and people are always finding one approach or the other. So we think that there is a lot of similarities, but also there's a few key differences as well. Both SRI and halal investing prohibit certain investments in certain industries, such as as I mentioned, gambling, weaponry. The main difference is that halal investing also prohibits the use of interest or riba, and follows a strict criteria for companies' leverage, where SRI mostly focuses on business ethics and practices such as company diversity and so on. So both can coexist. We find like pockets of opportunities for both SRI and halal to sort of be mixed together to be represented by certain products and so on. And this is again opportunity for managers to come up with the products, because it will appeal to both Muslims and non-Muslims as well. So you can have the best of both worlds in that sense. Yeah. So with that, my presentation ends, and I look forward to the panel session. Our investment methodology, we can speak when there's a question later. So I'll speak later. Yeah.
All right. Thank you so much to Izzat, Mr. Freddy, and Pandura, of course, because I think those slides really helped us to sort of come up to the same sort of level in terms of where we are. So it was a really great starting point. I just want to remind the audience once again, that we definitely welcome some comments and questions via the link which is on the chat. So if there's anybody who wants to have any of their burning questions answered, please do, of course, put it on that link in the chat. If you're on YouTube, you can also look at it on the chat over there. And, with that being said, let me just kick it off, because there's a lot of things that I actually want to sort of ask, because this is definitely a huge interest to me, especially since I am in the active industry, the active investment industry. So the first question, and I think I'll probably want to I would say, direct it to maybe Dura and Izzat, right? How was it like managing the transition from being an active manager to a passive sort of landscape? Now, what do you think are the main or the biggest differences in terms of probably thinking between these two sort of, I would say, rather distinct industries?
Okay, I can take that first.
Sure.
Yeah. So I guess this goes back to how do you look at investment strategy. So for those who are new in asset management, you would probably be not too familiar, but in general, we have this big argument between active and passive investments, right? And being a former fund manager myself, having managed equity portfolios actively, I guess it would be quite it is actually quite an interesting topic to talk about. And yes, I think in terms of changing the mindset or how we shift our mindset, I would put it this way. In the argument between active and passive is actually a debate that has been coined by the developed markets. But the ecosystem or the structure of developed markets are very different compared to what you have in more emerging markets like Malaysia or newer economies in Asia like Singapore and in Hong Kong. Okay, so in developed markets, passive and active is really competing against one another, because the distribution network is actually very wide across both kinds of strategies, where passive instruments like ETF are actually packaged into a lot of structured products and available as a banking product. So distribution plays a key role. So that's why the ecosystem or developed markets like the US, Japan, they have this big argument. Is it passive or active that is better? Now I bring us back to Malaysia, and in understanding as a former active fund manager, how do I look at that? And I would actually say, when I look at this ecosystem in Malaysia and the dynamics of our capital markets, there is no one strategy that is better than the other. In the longer term, both strategies will be complementing one another. And the reason I say that is because the way capital markets in Malaysia has developed was starting out using a lot of mutual funds or unit trust structure, with most of you, your parents are all very familiar with. You've probably inherited a lot of these unit trust funds from your parents, and these are what have been actively managed. But also because of the way it started with mutual funds, and back then when markets are not as transparent as now, where you can just switch on the internet and have Bloomberg and know all about global markets. So predominantly there was a lot more issuance in Malaysia and Asia rather than global issuances. So as we evolve, capital markets will require these gaps to be filled up. And this is what I was mentioning in the slide earlier. And because of that, the passive space is what is actually going to complement the gaps that is faced by the investors in the active space in Malaysia. Now, this is why I say myself as a value partners as an all-time a very active house. Our evolution is very interesting, because whilst we always recognize the value and the importance of active management, especially for investors who appreciate buying the right stocks, Alibaba before it was listed and so forth, what's also important is to understand other markets that you are not capturing. Value Partners is highly specialized in China and Asia, and exposure to other markets would require a bit more of a approach that takes better risk, better managed risk when you do it, i.e. via passive instruments. So this is why I say in an ecosystem like Malaysia, maybe even Hong Kong, maybe even in Singapore, it's actually going to be complementary of one another. And as a fund manager who used to look at active portfolios, you will see that there are gaps that your own portfolio, there are gaps in your own portfolio, and you would need the issuances of all these passive funds to fill it up in managing or in stabilizing portfolio volatility, and also contributing to portfolio return and diversification. Maybe I can pass it to you. Right.
Yeah, I can talk a bit about my personal journey. So the change from being an active manager to a fund manager at Wahid. Of course, again, all three of us know that when we were portfolio manager, both Durrani and myself were portfolio manager, the idea is always you have to find the best alpha generating ideas, right? Because at the end of the day, you want to beat a certain benchmark. And not only that, you want to beat a certain benchmark within a certain time period as well. And this sort of, you have finding the timing right, finding the stocks right, doing a lot of research.
Isa, it seems that you have been muted.
Oh, sorry. Can you hear me now?
Yes, sir.
Okay, so from active to passive, now you focus more on asset allocation. So like Durrani said, because you no longer look at price fluctuations. You look more to have certain kind of exposures, be it geographical exposures or sectoral exposures, you want to, again, you intend to mimic a certain performance of a benchmark. You don't intend to beat it because, again, the debate between active and passive, there are certain reports saying that, being passive over the long run is better. There are certain outperformances that you can have over active managers, and at the end of the day, as an investor, as a fund manager, as an investor, what I would like to sort of advise everyone is that focus on things that you can control, which is number one, you want to be active or you want to be passive, it doesn't matter, but you look at costs. You look where you can lower costs. And at this point in time, if you go passive, then of course the cost will be lower. Even if it's lower by like 50 bips over 5-10 years, it can make quite the difference, right? Because it doesn't eat up to your returns as much. And again, comparing active versus passive again, if you're an active manager, you can fall to certain like biases because there are certain stocks that you like, there are certain sectors that you like, and that can sort of become a drag to your portfolio if it doesn't turn out the way you want it. So these are sort of like mental shortcomings that you have. So I can safely say that I don't have that anymore, which is good. And I think the third point that I would like to make is that whatever it is, whatever products that or whatever strategy that you have, always diversify. Diversification is always the best strategy for investor in terms of getting the best risk-adjusted return, right? And you always have this saying that you should never put all your eggs in one basket. For those who have stayed throughout, Wahid, at least for the last 1.5 years, even though we had sort of a COVID sell down last year, but those that consistently put in like recurring deposits, they saw the actual returns that came out from that because they actually captured the lows in terms of getting their portfolio cost low and getting the higher returns from there on. And I think the last point I would like to make is that you always have to focus on the longer term. So earlier I mentioned that when you are an active fund manager, you're trying to beat a certain benchmark within a certain time frame, which if you can do it, like it's great. There are of course a lot of very good performing active managers, and they have been doing very well because they have certain tools that allow them to do so. Where as I mentioned earlier, certain reports also indicate that there are active managers that cannot outperform passive benchmarks because they have certain restrictions, they have certain limits. If certain stocks are down, you have to take certain losses and so on. So focusing on the long term is very much key for any investors. You don't have to look as much into the fluctuation of the markets. Just have a goal in mind now. Year one, what you want to have in year 5, and just stick to your strategy until then. Yeah, I think that's what I'd share.
Right, thanks. Thanks a lot, Izzat. Maybe I want to direct the next question to Freddie. First of all, of course, congratulations on Statutory passing the $1 billion mark. So huge kudos to Statutory for that. And that's exactly what I want to ask about, to be honest. So Dura mentioned something very powerful. She said, shifting mindset. Right? So at the end of the day, it's all about the challenge in how do you shift mindset. So do you mind just walking us through Statutory's early experience, those 4 or 5 years ago? What was the hardest to change in terms of educating, and how do you manage to overcome that hurdle of introducing a very, very new kind of product in this market?
When we first started, my memory sort of told me that majority of Asian investors are stock pickers, get a lot more active. So the culture is sort of different than what we see in Europe, which is very fixed income driven, and very, very, very different than the US, which actually is a lot more diversified. It is really difficult at first, but I don't know what's the factor that would contribute to the success there, but it's sort of like you do your best in every dimension. So the Statutory Academy is one great way to relate, because by signing people up to a seminar and teaching them data-driven facts, that sort of is a way to promote it, but it wouldn't really help you initially, right? It is a long-term investment on Statutory's part. And now when you fast forward the clock, it's 4.5 years. So you already reach out to hundreds of thousands of people. So the word of mouth will form. So don't underestimate the word of mouth, I think, in a sense, because in Asia, like if your family or friends whom you trust or whom you think are capable, and they sort of tell you to look at a platform, you would sort of take it more seriously than being marketed to online. So digital marketing is great. Obviously, we do that a lot, but I just don't want to say that it's just 1-2, but to really build trust, you need to have this word of mouth methods of relating to users. So I wouldn't say there's any particular factors that help us relate or change mindset, but sort of initially we throw the whole kitchen sink at the problem. Now, 4.5 years later, you have track record. We've been through 2 market correction in the trade war initiated by Donald Trump. We've been through the COVID crash. So you have enough data to prove to people that, hey, you know, if it's a well thought out financial plan, it is solid and it has data behind it. So it's easier today, but every time Statutory goes to a new country and we sort of start again. You're not known, you got to start again, you feel like a startup again, everything from scratch. So we go through that. It's good to always sort of like be established in some place and look for the next place to open up. And it humbles you to go back to very basic principles, to changing people's mind. And you do that whole process again locally. So for us, Hong Kong, we just started again recently. Dubai is the same, Thailand's the same. So we still feel like a startup. We still feel like we are beginning again. Yeah.
All right, that's great. That's great. It's always, it was always, must have been really difficult at the start. But now looking back, you can look at it with a big smile, right? Anyway, maybe the next question, maybe we can cycle back to Dura. Now, you mentioned that the ETF space here in Malaysia, at least, right, is, I would say, a rather sort of greenfield. You know, there's not many players at this point right now. So what is, in your mind, the most important thing that needs to change to grow adoption of ETFs?
Thank you so much, Farid, for that question. It's a very important question as well. What needs to change in order for the ecosystem to be more vibrant is actually first and foremost for market participants like ourselves to make the products or to create products that is efficient, transparent, and serves the function of an ETF in a passive portfolio. I think that is a very important place to start. I always like to look at history to understand why scenarios or the current situation is as it is now. So if you look at ETF and how it has evolved over the past 12 to 15 years, our peers in the market has done a great job by developing the first 10, I think before 3 years, up to 3 years ago, there was the first 10, first 11, right? And yeah, because they were pretty much guided by the mutual fund structure. So a lot of the ETFs back then was pretty much mirrored on that, which also makes the ETF to not be as efficient compared to some of the, or most of the listed ETFs in foreign jurisdiction that maybe even the team at Statutory, Freddie, is more familiar with. And this is because, as some of you would know, when people say passive investment ETF, they make it sound so simple. It's actually not a very simple space. It's the way to participate in it requires, as Izzat will also know, either via the secondary market or the primary market. So when your process is not efficient in the primary market, that creates a lot of distortion to NAV, that makes pricing not very transparent. And of course, it's, for lack of a better word, as an investor, it will translate into your own portfolio. So then you'll be able to see here where is your returns or lack of returns coming from, right? So market participants play an important role in ensuring that the product that we issue is efficient, transparent, and value-adding to investors. And then that comes the part where we have regulator. I think at some point later we want to touch about that, but I'll talk a bit about our regulator. Actually, our regulator in Malaysia has been, from my point of view, very advanced. They've regulated the ETF space far ahead compared to our peers in Southeast Asia, from Thailand and Indonesia. There were gaps, of course, simply because, like I said, capital markets is very jurisdictional, but they were very advanced in addressing it. And even when you look at the latest guideline that was issued by the regulator, LNI, in 2018, it was also ahead of the market. And also, probably very important to Wahid is that when they started regulating the Sharia space, and they were ahead of the market to ensure that in order to garner public confidence and support for the Sharia capital markets, regulation must be in place, especially for investor protection. So regulators have done a great job. Now, market participants like ourselves, regulators have done a great job. Market participants should do a better job, and our regulators have done a great job. So how about investors? This is where we are very happy to have the likes of Statutory and Wahid, and also a lot of the other online brokers participating and becoming more active in the market, because the exchange is probably the most transparent place for you to have to invest in securities. It's the most transparent because everything is live. On Bursa, settlement cycle is T+2. In some markets like China is on T-day itself. So you can actually see everything there. So that's why it's very important that we have players like Wahid and Statutory coming here to participate and ensuring that this access to a very transparent exchange is available. And we're very happy about that. So that's where we think that, that's where I think that in terms of the ecosystem, it can be improved or how it has evolved. Now, in terms of issuances of products, so this is probably where it's quite important for us to understand what exactly are we issuing. So typically we issue, asset managers like to issue strategies that are fashionable, in trend, thematic, for instance. Then we have to take a step back and understand exactly what we are trying to achieve in issuing a product. Is it meant to be a short-term gain, i.e. you issue a product that is sexy or generating alpha for the near term? Or are we looking at a more sustainable way for portfolio allocation for investors? And as an issuer like ourselves, we're trying to identify that. So that's why in my presentation just now, it was very important that when we came in, we looked at what exactly is in the market, what does the market need? And what does the market need then goes back to the correlation between what is already in the market and other strategies that you see all over the world. And why I like ETF and why value partners in Malaysia like ETF is as well that we are able to bring it back to Malaysia at a lower cost. Not forget that your unit trust is still charging 2% management fee and also 5% sales charge. Our friends at Wahid and Statutory are taking a very big discount cut compared to what our friends in the unit trust industry is doing. And that's very important because as you go along, we will see that fees, as mentioned earlier, has a real impact on portfolio returns. And you don't see it for 1 year, you don't see it 2 years, you see it over a period of 10 years. And that's pretty much how long you want to invest your money. So I hope that answers your question, Farid.
Yeah, definitely. Thank you so much, Dura. Yes, I just want to remind the audience once again that we can ask the questions that you want to ask. Yeah? All you have to do is just put those questions on the link that is at the chat. Yeah. So let's just pick up one. Yeah? And I like this question. It's very short and sweet, I would say, by attendee number 9. I think this will be by Izzat and Freddie. How do we choose the best robo-advisor? That's it. That's the full question. How do we choose the best robo-advisor? What would you say? I think if you want to interpret the question, it's like probably how do we differentiate between the robo-advisors? Because if you think about it, money is very homogeneous, right? So how do you sort of differentiate, especially from a customer point of view, amongst the robo-advisors? Maybe we can go with Freddie first.
Well, you got to define first what do you mean by best? If it's just return, track record is the way to go, but how long do you need that? Or also don't just look at the length, because I've seen fund managers who had a one-way dragon because it's like 9 years of bull markets and just it's really one track record. You really want to see those track record gone through different changes in the economic environment, right? So that's so you should be mindful even if you that's what you mean by best. I think you need to understand the philosophy of each platform. I mean, like as Statutory, there's a certain investment philosophies. Does that match your temperament? Does that match your own beliefs? And in the case of Wahid, is like there's very strong suit in Islamic investing. So halal investing, sorry. So it's sort of like, what is it that you need in your investment plan? And what's that philosophy? Do you connect with it? Does it match your personal aspirations? That itself would determine part of the answer for what is best, other than the track record. I'll stop here for Izzat to jump in as well.
I agree with Freddie here. Different robo-advisors have different, portfolio management styles, I would say. You have Statutory with the ERA regime, and you also have Wahid with our own methodology, which is in our white paper, in our website. So you need to look at what are the sort of differences that you're seeing. So at least what we bring to the table, what Wahid brings to the table is a full Sharia compliant suite. So if that is something that is aligned to your investment, meaning that you have to have permissible investments, then you would look more to say Wahid or other Islamic robos or Islamic financial institutions. Or if you're more open, then you can look at all of us basically and see which suits you best. Again, look at the underlyings. If you don't like certain exposures, then those are again different for other people's. Even in terms of determining the risk tolerance, it would be different as well, because just by the fact that there will be different underlying funds. And in terms of offerings, so usually when I see like websites comparing robo-advisors, they always look at fees, look at accessibility, and these are again valid points that you can always look comparing objectively which one is better in your own ways. If you want a cheaper, then you go for the cheaper options, but of course there will be variances in returns just by the fact that management style is different, underlyings are different, and probably the best way is to try all of us.
Spread it around.
Yeah, you can just diversify amongst the robo-advisors. that's a valid strategy.
So diversify. So it's not just your investments are diversified, even your robo-advisors are diversified.
If you want to.
Yes, because I think that's a really important point. What you said earlier on is that on that word, understanding the underlying. So it's not just. I think that there is a very interpretation. Whenever someone hears passive, they think that there's no there's no thought that goes into it. But actually, even amongst the robo-advisors, there are ways that they are generating alpha. Am I right? So it's not purely passive. So in that respect, what would you say? Maybe direct it to maybe Freddie and Izzat again. What are the ways that robo-advisors can squeeze out that little bit of alpha for their customers? What would you say?
If I just take it very quickly, so certain robo-advisors have a strategic or tactical move or a tactical tilt that they can take during certain market conditions. So you can, of course, you can benefit from that if you have, for example, an exposure to small or large cap, and during certain market conditions, you tilt one way or the other, you can generate alpha from there, which we don't do. We mostly stick to our style and rebalance whenever there is a periodical period that we do it. But a lot of the US robo-advisors, they have this kind of active managing of their passive portfolios. And that is, again, there is another criteria that is at the moment for us in Malaysia. We don't really have that many players yet. But if you're in the US or in the other developed markets, certainly you'll find this robo-advisors trying to obviously get better returns for their clients just by this tactical tilts. Yeah.
Well, I think you need to strike a balance with sort of your the horizon of the users, and if the platform is promoting at the very least a medium term sort of positioning, then ideally your asset allocation methodology should be compatible. So in the case of Stashaway, it's more medium term in nature because our allocation logic is decided by economic cycles. Economic cycles as a starting point, and economic cycles can easily last between 3 years to 7 years, but sometimes can be 20. Look at Australia, right? So it really depends. We quantitatively determine that and we allocate accordingly. Some prefer to, overlay a little bit of a tactical aspects like valuation adjustments. When something is just way too expensive, even in good times, there are better places to park your money. So there's so many ways to go about. The US players are more focused on tax loss harvesting. So they actively book losing ETFs for the year and replace it with a similar one. But again, I'm not a big fan of that because you're just counting what you save, but you can't like for like replace the assets that you sold. For example, you book profits on the S&P 500, and in return you buy dividend-focused stocks. Then the performance could be very different, and sort of the bin counting approach do not account for the opportunity cost of now switching from a broad one to a dividend-focused one, right? In good times, for example, this is a bad strategy. So in a way, there's many ways, but I believe the data-driven approach is the best way. But design a system to be compatible with the user's horizon, with the platform's horizon, I think is a natural place to start. I'll stop here.
All right. Thank you so much. Thank you so much to both Izzah and Freddie for answering that question. One more time, I want to remind everyone, if you have any questions, please do just drop your questions in the link that is in the chat. I'll take another one out from the hat over here. Well, this is also a rather broad question. So maybe I'll direct it to all members of the panel, maybe starting with Sedura. Considering the birth of many robo-advisors, what would you say is the outlook for traditional asset management? What would you say?
Thanks for that, Farid. I think we have to join them. We have to embrace them. And I think that is what value partners here in Malaysia have demonstrated. We have a DNA in active, but we're not shying away from issuing ETFs. We are embracing ETFs. We are coming into a market where they need more ETFs to be issued so that it complements investors' portfolio allocation. So traditional asset managers like ourselves, we must find a way to make ETF part of the business. And when I say ETF part of the business, not just as a money-making machine, but actually largely to give investors the opportunities and the strategies that they are missing in utilizing mainly in the past active strategy. For instance, like value partners, we are predominantly in Asia and China. We can't say that enough, and we take pride in it. In one of the articles that was recently published on our chairman was that we actually bought BYD, the battery maker, far ahead of Warren Buffett, and we sold it to Warren Buffett. So that is how stock picking is such a strong part of our DNA. But are there things that we can do better? We have a gold ETF which complements, if you are an investor or value partners, you have your Greater China strategies, you have your China A, you have your China bonds, your Asian bonds, and then you also need your commodity exposure. So that is where we find that ETF is very important. And for us, especially like for me, the way I look at ETF is that there are these very sexier and newer thematic ETFs with AI and healthcare and so forth. But what ETF also can be is just a very basic exposure to markets that is not easily accessible. Case in point for us is China A. It's a market that can only be accessed via Stock Connect or via RQFI. So it's not like your everyday investor can just pick up the phone, call their broker and get a stock in China A, right? Especially from Malaysia. So this is what an instrument like an ETF should be doing. What's also a difficult market to access, probably Wahid will be able to speak more, is actually the GCC equity market. It's largely dominated, of course, by Saudi Aramco, the index. But it's not as easy for an investor to just pick up the phone and say, hey, I want exposure there. And what's also important is to go back to that little slide that we showcased just now, is that the correlation of these exotic markets that's very difficult to access is very low compared to your traditional strategy of global equity, Asia ex-Japan, and even Malaysia, because Malaysia being exporting economy, right, we are highly correlated to the US and global equity. The correlation is close to 1. And when you think of the landscape in Malaysia, most of our issuances are in Malaysia. Hence why ETF becomes important, and players like ourselves, and I hope not just us, but even all of our friends in the market will embrace ETF, not as a way, not looking at it as cannibalizing our business, but complementing it. And I welcome Wahid, and we welcome Statutory in promoting the landscape even more. Hope that helps.
Maybe I'll add a bit. Sorry, yeah, just adding a bit. So at least for a pure DIM company, right? We are a portfolio management company, but we are still subscribing to third-party funds. And these are where the traditional asset managers come in. Like Dura said, this is an opportunity for the asset managers to come up with ideas, be it passive or, I mean, of course, for robo-advisors, we use passive funds. But what we have shown, what Statutory and Wahid have shown in Malaysia at least, is that we are sort of the distribution channel for these funds. Digitally, we have been able to, take in retail clients a lot quicker. You have this very quick sign up, KYC done very quickly. Overnight, you can deposit your money and you can start investing very quickly. The traditional asset managers have to look at this as an opportunity for them to, in a way, to better provide the products to the retails in the market. So in Malaysia so far we've been able to cross 200k open clients. So that is, and 50% of them is actually from outside KL and Selangor. So if you think about it, these are in terms of wealth distribution, also not as much if compared to the Klang Valley and Penang area, but these are where you want to sort of focus to sort of give your best effort, because you want to have you want to give the best investment solutions to everyone in Malaysia, not just the rural, the high net worth, and so on. So again, just stressing out the point that it should be an opportunity for the traditional asset managers as well.
Sorry, just some 2 cents. I think the line is going to blur, given enough time. The line is going to blur between traditional and digital asset management. One day we're just going to say asset management, because the pressure is on, and traditional asset managers will respond. We're not going to just assume they're going to lie down and just wait, for things to happen. So they will respond. And we already seen that giving access to parts of the market that's not accessible is one way to have niche. And Bandura has been emphasizing that for a lot, right? And so they will force them to find niche. That's one of the result of competition. And however, the bar is always going to be higher when it comes to active management, because it does cost more resources and effort to do it right. And so in a way, the passives could pressure the active to get better. Then one day, you can't say there will be 0% active one day. I really don't believe that's going to happen. If you find a very good fund managers, treat them with respect. It's not easy to find, but they will be there. And it will be a mixture of a lot of stuff. So the outlook would just be everybody is going to be called asset managers one day, digital or not.
Understood. Yeah, that's actually the answer to another question that came up, which asked about the criticism of passive investing is that it sucks up market liquidity and it sort of pushes markets away from fundamentals. And if basically what you're trying to say is if the majority of the market is driven by passive, then it will sort of exacerbate the effects of price discovery. And
I think this comment is missing a very important link. I'm sorry, I will be blunt, because the leverage component. If it's truly passive people using ETF, you're investing your own money, the real money. You're not borrowing 20 times to trade something, right? So compared to a hedge fund that easily leverage 5 times, sometimes 20, look at Archegos, who's just blown up 20 billion in a day. Ultimately, it's about, yes, it's getting more percentages and assets in there, but the leverage is 1-for-1, then there's nothing to worry about. But if leverage is there and people are using ETF to do it, then sure, we should get worried. So I think at the moment, we are really in the camps of real money rather than a lot of leverage. But I can't say in the future, because maybe you'll find it's cool to get a 10x, like an ETF that has this 10x of the underlying movement sort of thing. You see that in gold. You see a lot of synthetic ETFs. So we're not saying that all ETFs are made the same and they are safe. In fact, some of them have leverage embedded in it, inverse, and all kinds of funny stuff can go on too. So it really depends. As of it stands now, the share of ETFs in the global assets under management is still very small. It's roughly around, if I'm not wrong, it's about $7.8 trillion out of 80 trillion in global assets under management. So it's still the small guy we're talking about. Mutual funds, 25% of that pie, right? So hedge funds, 5 trillion with leverage 5 times. So they're really like 25 trillion. So at the moment, we are not there. I can't guarantee in the future, but I don't think we are there today.
That's a great point.
I think that the point about price discovery is that it's only affected if a lot of trading is done, right? And for ETFs, the trading is done, from the ETF unit holders to one another, not from the underlying stocks, right? So I think there was a research by the Bank of International Settlements that say that in terms of the trading volume of the underlyings of ETF, it only consists of about 5% of the market. So in that sense, it won't affect price discovery as much. Even if I think again, I have to quote that this is probably by Bogle himself, that even if the trading volume of underlying stocks of ETF reaches 90%, price discovery will not be affected as much, because there will still be asset managers to arbitrage.
Yeah. That's a great point. That you brought up. We have about 20 more minutes left. Yeah? So for the audience, if you have any more questions, please keep them coming. There are actually a lot of questions here which are very, very interesting. And this is one of the ones which definitely would like to hear your thoughts on. So active ETF, especially the ARK ETFs by Cathy Wood. This is an example of an active ETF, right? The ARK ETF. So how does that factor? I mean, how would a robo-advisor such as yourself really utilize, or would you not utilize an active ETF? Does it have a space in your algorithm?
The key principle for this is that when you invest in tracking ETFs, you sort of know the asset class, the underlying asset class behavior. And in our case, we would like to know their behavior, how they change, return and risk, how they change with the economic cycle, right? However, if you can do the same to an active manager, at least if the active manager is consistent, has a methodology, then the same can be applied to active ETFs as well. However, in the real world, most cases, active managers do have style drift. Maybe you had a divorce or two, have a few more kids, or your golf handicaps go down. Maybe your return change because behavior change. So the consistency in behavior is often a problem when it comes to active fund managers. But if you have an algorithm that can understand the fund managers behind it well, and you can sort of know what to do with expected return and expected risk number across situations, yeah, I mean, that's possible to put it together. So in the case of the ARC funds, it's not really active in terms of trading in and out. It's more like they don't care the market angle. They view things from the non-financial angles, meaning disruptions. All the analysts that work at ARC, they're thinking about futuristic trends, about society, how they change by this investment. So they couldn't really care less about how the market is dropping or going up, right? So investing in that, you got to know that. And these funds can have higher volatility. That's fine. You can always have a smaller allocation to counteract that. So it is a good fund that's running a bit of a short-term headwinds right now, but as long as the fund has a philosophy and mandate, it sticks to it, understand it, allocate it accordingly, and it's fine. It's just my 2 cents.
Thanks. And I just have to ask Value Partners Dura, huge brand name, right? Dato Sri Chia, Value Partners in Hong Kong. Active management, stock selection is in your DNA. So is an active ETF something that you're considering?
Very interesting point. So I come from the school of thought of complementing one another. So we already have a very strong active strategy across different strategies that the group can offer. So what exactly is an ETF for us? Just the way we look at an individual investor in Malaysia, what is the ETF for? The ETF is actually to fill up the gaps. ETF is actually to diversify further your portfolio. So from my point of view, the ETF serves the portfolio, diversifying the portfolio, whilst the active strategy, which is in our DNA, remains the same. So that's the beauty of the ecosystem, right? We don't have to adopt each other's way of doing things, because we already have a core strength that is synonymous with our own branding. So what is it that we need to do more for our investors, for our clients, in order to make the investing experience more wholesome and holistic? It doesn't mean that it has to follow exactly what our friends at Statutory and Wahid is doing. It means that for the core business that we have, what exactly is needed to enhance it even more? So at where we are at this point, a single market plain vanilla ETFs, having access into very exotic markets with low correlation to traditional strategy, we think is best. It's most challenging to set up, but we do think that it would provide the value of diversification of portfolio for investors that they couldn't have seen before without us putting this effort into it. And I think that's actually how we would view it. But what I say will probably be different from what, say, another traditional asset managers is. Maybe they want to revamp completely the business and focus more on entirely on ETF, be it active ETF or passive ETFs, right? But for Value Partners, we still have our core DNA, which is active, and we've been producing consistent return for 28 years. And it's not something that we should discount or ignore for the future. And we do think that investors will still want to have that taste of very strong stock picking, the next BYD that we can come up with. I'm sure investors are really still looking forward to that.
All right, that's I just had to sort of put it out there. Maybe a question for Izzat, Wahid. This is also something that's been in the news at least a year and a half. Crypto. Yeah. So does crypto or new assets such as crypto have any part in a passive investment portfolio? What would you say?
Interesting question.
Yeah, exactly.
I think personally, if it comes down to personally, I would give it a bit more time, because the argument for crypto is that it is a store of value, right? It is the digital gold. However, let's say we take the biggest crypto available, Bitcoin. You still have this halving periods, right? Every 4 years or so, and each time you have like a big volatility that comes afterwards, just by the fact that supply is restricted. New demand comes in. We saw this in 2017, I think 2016, 2017. We saw this again last year and this year. And if you have such volatility, how is it going to be a store of value? I mean, at this point in time, I would argue that it's a bit difficult to have it in a diversified portfolio with other passive instruments. You can treat it as a separate sort of strategy that you have, meaning that you will have your passive strategy, and then you have your other alternative assets, and then crypto can be there, alternative assets, with your, for example, with your private mandates or whatever. But allocating it in a diversified portfolio at this point in time, I think the volatility will present a huge problem.
Right.
That's
So
my
it's
take on it.
mostly, so you say it's mostly the function of crypto in the first place, and it needs a little bit more time until it matures as an asset class. Is that
in terms of the utility, in terms of the usability, when it's widely used, when the volatility comes down, then probably then we can sort of treat it as a quasi cash, if we want to treat it as such. But again, at this point in time, it's a bit too volatile for my liking to be treated as a diversification, to give any diversification benefits in the portfolio.
May I jump in?
Please do.
I do give lectures on network effects and the likes. So what crypto really is brilliant, the idea of it, the way it's born, is that we don't have to know each other and trust each other, have a central clearing party or the government in the middle, right? Collectively, the network, the first X number of people who can verify the transaction, everybody sees it, it cannot be changed anymore. I think that fundamentally it is a sound concept of decentralizing the processing of transactions. However, because it's backed by nothing, it is according to something called a McAfee law, which is like the Morse law equivalent in chips. So for network effects, so when anything that's not relying on, does not have an anchor, it will be volatile because the value of the network is now square proportional to the number of active users. If you apply the same law to Amazon, Facebook, Tencent, companies with a huge marketplace where people buys and sells and have a certain sticky behavior, you can value those stocks better than traditional earnings per share discount cash flow methods. So because these are very network-driven companies, so you should view crypto the same. It's about a network. And now the problem is that you don't just have Bitcoin or Ethereum, you have 6,000, 7,000 coins out there competing for the same attention. So when the number of active users goes up, Square impact up. When the number of active users goes down, Square impact down. So even without human greed or animal spirit, it's designed to be volatile because of the network effect, because it's backed by nothing. It's just based on utility, right? Utility-based token. So I just want to put it out there. It's by design going to be volatile. And investing in it, you want to diversify because you don't know which token will survive one day. You really want to spread it, which is tough to do today. Bitcoin may not be the right answer. There may be other coins, right? You never know. I'm still amazed how Dogecoin make it to the top 10, but it's amazing as well. So either way,
never underestimate the power of a cute mascot.
The meme stocks is now the effect from crypto has gone to meme stocks now, right? So GameStop, AMCs. So you never know the power of social media and the impact it has on investing behavior. So to be safe, you want to allocate some to the space, but you want to do so at an amount that's compatible to the volatility. It's really ultimately, that's the principle doesn't change.
Sorry, just to confirm, it's called McAfee's law?
McAfee's, yeah, METCALFE. There's quite a couple of articles in the Journal of Computer Finance that actually uses this law to value stocks like Amazon, Tencent, Facebook, places with a lot of network effect. So it's much better than discount cash flow models. Which also explains why Amazon is a great company, but the stocks are volatile. It explains that. Yeah.
Because like these companies, their market is no longer domestic, right? All these $1 trillion companies have something in common, which is global footprints, right? So that's something which I'll definitely try to read out after this. Okay, so we have 10 more minutes, and there's, I would say, two questions that I can sort of lump under the same umbrella, which is trust. So the thing about these financial products is that a lot of it depends on trust, isn't it? I trust you. I trust you to number one, of course, not lose my money, not run away with it in the middle of the night. Number two is also, I trust you to not lose it in a market event. So one of the questions here was asking, in terms, what happens when there is a black swan event? So for example, in COVID, how does the algorithm adjust to that? Something that is not in the, I would say, in historical scenarios.
I'll give you a short and quick answer. You don't adjust to it when it already happened. You do have to prepare from day one. We always tell users, before you invest, here's a few things that you have to do. And so let me list it down. Number one, do you have a rainy day fund? Is there like 12 months or whatever that suits your personal situation? You have that first. Don't invest first. Have that. Two, do you understand yourself? Do you know your risk level? Right? So you got to get that right as well. So that's what the app and the algorithm tries to decipher for your background and your own personal situation. What is the right risk level? Now, then our job as fund manager, we cannot avoid markets ups and downs. It's inevitable, but our job is to say, if our app or our estimation of risk is this, and when COVID happens, then hopefully, ideally, our risk estimate is close to what we told you as your 99% VAR, right? What's your value at risk? If it stands during a crisis, that's amazing. And if I told you you choose this portfolio, there's a 1% chance of losing 20% of your money. And during COVID, you lost 16 temporarily. What's the problem? You were told from day one, this is the rare event that will happen, and this is a number. You didn't break it. Your fund manager has done a great job. So I think you got to put it in the fair perspective. And I feel it's all about the risk estimate and how well they stand in stress market situations.
So does that mean that the algorithm, does that mean that the algorithm has already backtested or incorporated these?
I would rather say stress test. Backtest is sort of like for promotion or marketing. You always show that something works, and it always works until it doesn't work. We prefer to stress test. So meaning what we do as Statutory, we call it the Statutory Risk Index. It doesn't have a window or period to go back to look at risk. It actually goes through entire history and look at only the downside. And in particular, we compare to the top 10 greatest market meltdown ever. So the estimate will be compared to the top 10 and see whether we capture at least 90% of those drawdown in the top 10 crises. So 2008 comes out as number one. 97, 98 came in, 2011 European crisis comes in, oil shock 1973, COVID obviously will make it now. So you stress the portfolio through this scenario. Don't try to, we don't think it's easy to forecast the future, and every crisis is different. But what you want to do is to stress a portfolio and say, if they happen again instantly today or tomorrow, is the expected drawdown sort of close to what we think your statutory risk index is? And then if that's the case, I think your fund manager has done the job, right? So, but we try not to forecast that. We just try to stress test it. Yeah.
All right, I think that's where I wanted to probably bring this back to how exactly we look at it from the investor's point of view, right? So for Statutory being a full-fledged robo-advisor, relying entirely on algorithms and also on a lot of your back testing, which obviously is very important part of asset management. For us, I think the way you look at it, that's also what active managers are there for. So this is not going over the whole active versus passive. This is the value of active managers. When you understand the market, the word that was used in the question just now was something that we discussed earlier. Trust people. 6,000 due diligences a year is what is done by value partners. And I'm sure our competitors and our friends in the market are doing about the same, if not more. That is what gives you a feel of the risks that are to come, the risk that you should embrace and the risk that you should avoid in investing in the company, in in allocating your portfolio in a certain manner, in allocating your portfolio into certain sectors. We had the big blowout from the end expected IPO last year, which caught a lot of people off guard. But knowing the market, knowing the regulator, knowing the ecosystem, some of the asset managers on the ground, the active asset managers, had already anticipated that. So that's why I'm saying that whilst there are other means to avoid that risk or minimize that risk, this is also the value of active managers. So as much as it's very important that I say that ETF comes in to complement the active managers, this is the value that active managers for the past, from 100 years ago when they started out, actually brings to the table when it comes to portfolio allocation.
Very wise words, very wise words. All right, so we have the last question, and I actually saved the best for last. Yeah, this was done on purpose because this is a question which I didn't write it, but I would also love to know this. How rewarding is a career in the digital investment manager space or robo-advisor space as compared to a traditional asset manager? Which is more rewarding? Interpret it as you like.
Okay, sorry, I always jump ahead, but no, I think that the kind of jobs that you have in a platform like us is very diverse. It's not just investing job. There's marketing roles, digital or non-digital. There's a PR component. There's content editor that looks at everything that we wrote that goes out. You also have a mobile app developer. You also have cool people with purple hair and designer t-shirt, walk around. They're actually designers. They design a website, they design a mobile to look and feel. They talk about the font types. They talk about different things. So it's just very, very diverse when you are in a firm like in FinTech, because not just about the fin, it's also not just about the tech. It's just a lot more going on. And I'll leave the rest to be sorted out by Izzat.
I think the rewards are different. Back at PNB, you would have you work as a fund manager, you deal with analysts, you go to company meetings, you go to fund meetings, and you get a general feel of the market to sort of better suit your decisions to make certain stock selection and whatnot. Whereas when you work in a fintech, especially, there's a lot more going on. Like as Freddie said, you're much more involved on the product side. You're much more involved on the system side. But again, it's to different people. There will be different answers. I think for working in a fintech, you have to embrace sort of entrepreneurial sort of skill set. There's a bit of self-starting involved, which is different from when you're working at a large organization, and the way you sort of work is also a bit different. We do a lot of agile project management. We do a lot of sprints. You try to sort out certain problems within like a week or two, find the short-term solution, identify the long-term solutions, and work from there. Execution is a bit more different, and yeah, I think I don't want to be like politically correct, if I may say so, but the both are rewarding. It's just you just have to find like joys in working like in one or the other, right? And it will be different for different people. It might be it might not suit certain people's style, but at the end of the day, it's how you make out of it. So I'm not trying to be philosophical, but yeah, that's the way I see it.
Dura, please. This is something that every panel member has to answer.
Of course, I'm very happy to. Of course, not from the very sexy fintech company, but I would say this is something that actually came up in our discussion before the session. Freddie and Izzat and I were talking about what is that one thing that is needed in order for you to thrive and strive in your career, right? Whatever it is in fintech or not in fintech, is actually agility. So since we have a very young crowd, I would believe, listening in today. I think the agility part is the most important part. I've worked with Izzat for a long time. I've observed Freddie for a long time. And to be where they are, it isn't just a function of working hard, doing the right thing, getting things done and moving on. It's about capturing opportunity. It's about identifying opportunity. It's about taking risks. I would say informed risks, of course. And on top of that, it's also just about having the right attitude. So you could be in fintech, you could not be in fintech, you could be in the most traditional asset management firm. But if the attitude is right, agility is there, and you're able to have an impact or change, definitely you will thrive and strive in your career wherever you go. So that's the word that Freddie and Izzat and I used just now. It's all about agility. So I hope that helped.
Definitely. So if we could sum up everything, I mean, that's a wonderful way to sort of end the session, because if I could sum up the entire discussion that we had today, it will be those two words, right? Adapt and agility. You have to be agile when markets are moving up and down. You have to be agile. The industry landscape is changing rapidly, from conventional mutual funds to now robo-advisors and God knows what next. So you have to constantly adapt, changing and mindset. So this is something that you definitely have to sort of take and sort of inculcate into whoever wants to enter this space. All right, so with that being said, thank you so much to our three panelists, Dura, Izzat, and Freddie. Thank you so much once again for spending time with us. And also thank you again to the audience for their insightful questions. Now, before we end the session, I'd just like to promote the last part of our FinTech Forum series, which is next week, same time, same place, on cryptocurrency. Is it at a point of inflection? So this is very, very interesting, because for the first time ever, we have the three largest cryptocurrency players here in Malaysia. So we have Luno, we have Synergy, and we have Tokenize, which was recently acquired by Kenanga. So we have the three largest crypto players right here in Malaysia, and so that is a session that everyone has to attend. Will be moderated by my very good friend, Jin Yong, and it's definitely going to be a fantastic session. So with that, thank you very much. And we will see you next week at same time, same place. All right. Thank you, everybody.